Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes
selling
down?
a stock because it goes down. I mean,
If you think about the stock market, most of the investors in the stock market are passive.
but some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated.
eBay is down 6.5%, and really you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
Today we're going to be talking about DCA. When we're talking about investments in stocks, ETFs, mutual funds, and crypto, there is one strategy that always pops up for long-term investments. Crypto guys say it a lot. So what does DCA actually really mean? Hello, I'm David Ofiare, and you're welcome to One Time High. I'll start with a variation of a very popular story that has always been shared by life and investment planners over time that I've listened to. So here it goes. An investor earns $900 every month, out of which he could only invest $90 off each month's earning in a stock of his choice. Instead of saving all that money and waiting for the price of that stock to reach a very low point before investing, or waiting for a time where he has a huge amount like $5,400 before going in, he starts dropping $3 consistently into that stock every day. And no matter what the price of the stock says for that day, he buys $3, and that adds up to $90 for each month of blind purchase. At the end of 5 years, there is no much difference between him and his wealthy friend that bought a lump sum of $5,400 at one time in a 5-year period. In fact, he even got the stock at a much better price, at much better earnings, because he spread out his investment like a blanket. That's exactly what happens when you DCA. You don't have to worry about the price of a stock or the price of an asset. You just buy like you're blindfolded, and over time it becomes very, very profitable. This is a very good strategy for bear market investing because many famous bear markets last for a period of 4 to 5 years. And if you buy a great asset all through this free fall period and all through the period it climbs back up in price, you look like a magician at the end. But keyword, DCA only works for great investments. You have to be sure you've not picked the wrong assets. Assets that have stood the test of time for a very long period of time are a good place to start from. I can say much about Bitcoin, I can say much about Ethereum, but I can't say much for the rest of them. Of course, none of what I say in this video is investment advice. This video is just for entertainment, but then you get the point. So, to define this concept, DCA, also known as dollar cost averaging, is a strategy for long-term investors who may not be so rich or are just smarter to build wealth by investing their money in equal portions at regular intervals on a great asset, whether the market goes up or down. It removes emotion from investing, and you can set it up to run automatically, and it helps reduce risk and guesswork. The downsides to this are very, very relevant to this discussion. As a matter of fact, just invest. Once again, I'm David Ofiare, and this is One Time High. See you next time.